Welcome to The Explainer. Today, we're skipping all the complex financial jargon and diving straight into the actual physical mechanics of bank failures. Most of us just walk through life assuming our money is sitting safely in a big metal vault with our name on it, just waiting for us to come pick it up. But the structural reality of the banking machine, it's vastly different. So let's lift the hood and uncover exactly what happens to your cash the very second it crosses the teller counter. To truly understand this, let's ground ourselves in history for a second. Picture this. It's October 1930, rural Nebraska. We've got a grain farmer named Harold. He's just deposited his entire harvest, about $4,200 into the First National Bank in his small town. That is an entire year of back-breaking labor. But a few days later, when he goes to withdraw just $80, the front doors are locked. He can literally physically see the vault through the front window. But his money? It's gone forever. His entire life savings vanished in an instant. And it's not like he gambled it away. He simply did the responsible thing and deposited it. So how does that even happen? Well, it comes down to a harsh legal reality that actually still serves as the exact foundation of our banking system right now, today. When you deposit cash, you don't own it anymore. Actually, scratch that. It's more like you are legally lending your money to a private corporation. In contract law, that makes you what's known as an unsecured creditor. And in the strict hierarchy of bankruptcy, unsecured creditors are placed dead last in line to get paid if the institution happens to go under. Now, modern banking gives us this totally flawless illusion of access. I mean, think about it. You swipe your debit card, the money appears. You use an app on your phone, and the transfer is instantaneous. It feels exactly like ownership. But the reality of ownership is completely different. The absolute second you hand over your cash, it becomes the bank's property. In exchange, they just issue you a liability on their balance sheet. Basically, it's just an IOU, a promise to pay you back later. And here is where the bank actually puts your money to work through what's called fractional reserve banking. Say you deposit $1,000. The bank definitely does not keep that full amount sitting in the vault. They keep a small fraction, let's say 10%, and they lend out the remaining $900. Then that borrower buys something, the money gets deposited into another bank entirely, which then keeps 10% of that and lends out the rest. Through the magic of the money multiplier, your original grant can generate up to $10,000 in credit across the entire financial system. It's kind of wild when you think about it. Now, this is a system that works beautifully in calm weather, but it holds a really massive fundamental mathematical vulnerability. It's called a duration mismatch. See, when you want cash from your checking account, you want it today. That makes it a short-term liability for the bank. But the money itself? It's tied up in a 30-year mortgage or a 5-year commercial loan. Those are long-term assets. So this whole beautifully designed system completely unravels the very moment too many depositors decide they want their money at the exact same time. And when that duration mismatch suddenly catches up with reality, you get a violent chain reaction. Going back to the 1930s, individual banks began locking their doors one by one. Then, in December of that year, a massive private institution called the Bank of United States collapsed, taking the savings of 400,000 depositors right down with it. Panic spread like wildfire. Everyone rushed to get their cash just in case, which of course became a self-fulfilling prophecy. By 1933, over 9,000 banks had failed, entirely wiping out $7 billion in deposits. Which brings us to the absolute core truth of fractional reserve banking. Confidence is its only load-bearing wall. Banks don't just fail because of poor management, they fail because they are running a maturity mismatch by design. The system literally creates more claims on money than physical money actually exists. And the second that public confidence cracks, the foundational math just flat out fails. So naturally, we try to fix this huge confidence issue with FDIC deposit insurance. We all just kind of assume the government easily covers our $250,000, right? Well, let's run the math. As of 2023, there is over $10 trillion in insured deposits sitting in the U.S. banking system. But the actual FDIC insurance fund, it holds roughly $116 billion. To put that into perspective, the fund mathematically covers just about 1.1% of the insured deposits. It is specifically designed to handle isolated failures. A flat tire here, a busted engine there. It is absolutely not built for a widespread systemic crisis. Let's fast forward to March 2023. And we can see exactly how this plays out in the modern era. When Silicon Valley Bank collapsed, a staggering 94% of its deposits were uninsured, meaning they sat way above that $250,000 limit. Now, the government did intervene and make those depositors whole, but we have to understand, that was a highly discretionary political decision. Regulators invoked a systemic risk exception. There was absolutely zero legal guarantee requiring them to step in like that. And this brings us to how regulators actually prefer to handle failing banks today. We're all pretty familiar with a bailout. That's when taxpayers forcefully inject money to save an institution. But as you can imagine, there is a massive political cost to making taxpayers foot the bill. So regulators have established formal rules for something called a bail-in. In a bail-in, the bank is stabilized quietly from the inside. They take the claims of the depositors and creditors, and they either write them down or convert them into equity. And if you're sitting there thinking a bail-in is just some obscure economic theory, let's look at the 2013 Cyprus banking crisis. When their two largest banks became insolvent, the European Union imposed conditions that hit depositors directly. Uninsured depositors forcibly lost 47.5% of their balances overnight. Boom, no warning. And the rules for this exact kind of resolution exist right now in the United States under the Dodd-Frank Act. It's actually the preferred modern regulatory framework. We also need to understand that this fragility isn't just ancient history, it's a current structural issue. By mid-2023, the U.S. banking system was sitting on over $500 billion in unrealized losses. Here's why. Banks hold massive amounts of long-duration bonds. When interest rates rise really rapidly, like they did throughout 2022 and 2023, the market value of those older bonds plummet. If depositors suddenly panic and demand their money, the bank is forced to sell those underwater assets at a massive loss, which triggers an immediate collapse. So if the banking system has all these structural vulnerabilities, you're probably wondering, where else do you put your cash? Well, let's be real. Every alternative has a trade-off. Physical cash avoids the bank entirely, sure, but it bleeds purchasing power to inflation. Treasury securities bypass private bank risk, but if you buy them directly, you have to navigate a government interface that honestly looks like it was built in 1998. And then you have money market funds. They feel like cash, but they're actually short-term debt securities. And during intense financial panics, they can actually break the buck and completely freeze up. Okay, what about precious metals? Gold has been the ultimate store of value for thousands of years, right? But we have to look at historical reality here. In 1933, President Franklin Roosevelt issued Executive Order 6102, which officially made it illegal for Americans to own gold bullion. Citizens literally had to surrender it for paper dollars. Plus, if you buy physical gold today, you have a major storage problem. If you put it in a bank safe deposit box, you're paying a fee just to put yourself right back inside the banking system during a crisis. Some folks look abroad to foreign accounts or towards real physical assets, but diversifying into foreign jurisdictions introduces deep regulatory complexity, potential FBR reporting penalties that are incredibly severe, and of course foreign currency risk. Real assets like land or property offer great utility, and they certainly cannot be digitally bailed in. But they are incredibly illiquid. You can't exactly spend a fraction of a farm at the grocery store. And in a deflationary credit crunch, real estate values often plummet simply because the credit dries up. So what's the ultimate takeaway from all of this? It's recognizing that the banking system isn't some evil conspiracy. It's literally just a machine. And machines do exactly what they are designed to do. Fractional reserve banking fuels entire economies by creating credit, but that exact same design creates its structural fragility. History clearly shows that during a crisis, this system extracts wealth from the uninformed, the people who just assume safety and don't ask questions. True protection doesn't come from finding a magical risk-free asset. It comes from deeply understanding the machine itself. Remember, a bank is a counterparty, not a vault. And counterparties can and do fail. The language and the regulations might have modernized over the decades, but the absolute core constraint remains unchanged. When too many people want out at the exact same time, not everyone gets to leave. So I'll leave you with this to chew on. When you look at the conditions that cause this incredibly complex machine to freeze, when the music finally stops, do you truly know where your money actually is?